Hello everyone, welcome back to my channel. This is Dr. Ramyashri MG, Assistant Professor of Commerce, Government First Grade College, Kumta. We'll discuss BCom 5th semester's Accounting Theory, Unit 5 Accounting Standards, Part 7 Accounting Standards issued in India. In the last part, we discussed Indian accounting standards from 1 to 8. This part includes Indian accounting standards 9, 10, 11, 12, 13, 14, 15, and 16. Indian accounting standard 9 deals with revenue recognition. This accounting standard has become mandatory from the accounting periods commencing on or after 1st April 1993. This standard deals with the basis for recognition of revenue in the statement of profit and loss account of the enterprise. Revenue is recognized from the transaction of service when the service is performed by the completed service contract method or proportional contract method as the case may be. This standard is concerned with enterprise and also with the recognition of revenue arising from the ordinary activities of the enterprise from sale of goods, the rendering of services, and the use by others of enterprise resources yielding interest, royalty, and dividend. Accounting Standard 10 deals with accounting for fixed assets. This accounting standard has become mandatory with effect from the accounting periods commencing on or after April 1st, 1993 for all the enterprises. This standard explains accounting for fixed assets excluding those items which have been specified under this standard. It applies to the financial statements of an enterprise prepared on historical basis. The other information to be disclosed in the financial statements of an enterprise are expenditure incurred on fixed assets in course of construction or acquisition of an asset, revalued amounts substituted for historical cost of fixed assets with specified details, gross and net book value of fixed assets at the beginning and at the end of the accounting year showing additions, disposal and depreciation, etc. Accounting Standard 11 deals with the effects of changes in foreign exchange rates. The accounting standard comes into effect in respect of accounting standards, accounting periods commencing on or after April 1st, 2004 and is mandatory in nature for all enterprises. This standard applies to an enterprise in accounting for transactions in foreign currencies and in converging the financial statements of foreign branches for incorporating the same in the financial statements. An enterprise should disclose the following financial statements: the amount of exchange difference included in the profit and loss account, the amount of exchange difference adjusted in the carrying amount of fixed assets during the accounting period, the amount of exchange difference in respect of forward exchange contracts to be recognized and in the profit and loss account for one or more subsequent accounting periods. Accounting Standard 12 deals with accounting for government grants. This accounting standards has become mandatory in respect of accounting periods commencing on or after April 1st, 1994. This standard deals with accounting for government grants including subsidies, incentives, etc. The government includes government agencies, local bodies, and government grants are the assistance by government in cash or in kind to an enterprise for past or future compliance with certain conditions. The enterprise should disclose the accounting policy adopted for these grants, including the method of presentation in the financial statements and also the nature and extent of such grants recognized in the financial statements, including grants of non mandatory assets given at a concessional rate or free of cost. Accounting Standard 13 deals with accounting for investments. This accounting standard comes into effect in respect of the accounting periods commencing on or after April 1st, 1995 and is mandatory in nature for all industries. This explains accounting for investments in the financial statements of an enterprise and the related disclosure requirements. The following information should be disclosed in the financial statements of an enterprise. The accounting policies adopted for valuation of investments, classification of investments in the specified manner, amounts included in profit and loss account showing separately the various incomes, profit and losses on disposal of current investments and on long-term investments including changes in carrying the amount of investments, significant restrictions on the right of ownership, realizability of investments or remittance of income or proceeds of disposal, aggregate amount of quoted and unquoted investments giving the aggregate value of quoted investments, and other disclosures as specifically required by the relevant statute governing the enterprise. Accounting Standard 14 explains accounting for amalgamation. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 1995 and is mandatory in nature for all enterprises. This standard deals with accounting for amalgamation and the treatment of any resultant goodwill or capital reserve as the case may be. This standard mainly applies to companies, but some of its requirements apply to the other enterprises also. The following disclosures should be made in the first financial statements following the amalgamation. Names and general nature of business of the amalgamating companies, effective date of amalgamation for accounting purposes, particulars of the scheme sanctioned under a statute, the method of accounting used to reflect the amalgamation. Accounting Standard 15 deals with employees' benefits on retirement. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 1995 and is mandatory in nature for all enterprises. This statement deals with accounting for retirement benefits in the financial statements of employers. This standard was revised in April 1st, 2006. The retirement benefit schemes are the arrangement of provide provident fund, superannuation, pension or gratuity or other benefits to employees on leaving the service or retiring or after the death of an employee to his dependents. The financial statements should disclose the method by which the retirement benefit cost for the period have been determined. In case the cost related to gratuity and other benefit schemes are based on actual valuation, the financial statement should also disclose whether such valuation is made at the end of the period or at an early date and also the date of such valuation. And accounting standard 16 deals with borrowing cost. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2000 and is mandatorily in nature for all enterprises. The objective of this statement is to prescribe the accounting treatment of borrowing cost in the preparation of the financial statements of an enterprise. This standard lays down that the financial statements of an enterprise should disclose the accounting policy adopted by it for borrowing cost and also the amount of such cost capitalized, capitalized during the period. It includes commitment charges on bank loan, interest and other loans, and amortization of discounts, premiums, finance charges in respect of assets acquired on lease, etc. Finally, Ministry of Corporate Affairs has notified a phase-wise convergence to Indian accounting standards from current accounting standards. Indian accounting standards shall be adopted by specific classes of companies based on their net worth and listing status. This part covered Accounting Standard 9 to Accounting Standard 16. These are the references. Thank you for watching.